everybody, and welcome to another episode of the Eitel Insights podcast. My name is Dane Eitel, and I am the founder and lead analyst for Eitel Insights. Today, we're going to get into the detached market and some of the economic realities that are going to transpire here, ultimately based on the coronavirus pandemic that's hitting the global environment, and basically the economic recession that seems to be hitting the stock market. Before we get into all of that, if you guys do find this podcast educational or hopefully a little bit entertaining, smash that subscribe button, give us a like, and if you do have any questions for us, leave it in the comments there, and we will hopefully get to it on a future podcast. Just on that, the last podcast, there was a question about the interest rate. We will definitely get into that as they actually had another change on that just before we came on to record this today. So, as you notice, the title of this podcast is The Charts Don't Lie. Now, what do we mean by that? Well, inevitably, you'll basically hear a lot of people talk about a black swan that is hitting this market. It's a factor that nobody could have seen coming. And they talked about it during 2016 and 17, a black swan that nobody could have foretold. That's not true, okay? Technical analysts, such as myself, and I am the only technical analyst in the real estate market right across Canada and, to our mind, internationally. We very much saw this coming. We've never waffled or went back and forth as basically every other analyst that covers the Greater Vancouver market did last year. Last year, you heard everybody waffling and saying, you know what? It's time to buy. The bottom is in. The time to buy is now. We never once said that. We did explain that there were some selling opportunities and you could sell into this market based on stress test mitigation, hitting up with 10-year uptrends, and that there would be maybe a bit of a rebound here, short-lived, in this Greater Vancouver detached market. Lo and behold, we were absolutely correct. Not shocking to us. We use different metrics, right? Our followers know and understand that. We use analytics, we use charting, and just as that, I'll throw this chart up on the screen. And basically, the way other companies forecast real estate market is by using fundamentals. They use employment data, they use average income data, and a number of different facets. Now, that's interesting, and it has worked to a certain degree in the past. It's only worked because nobody else has challenged it. Nobody else says, I have a better way. Eitel Insights does have a much, much better way. And we've been proven correct time and time again. So why is that? Well, we use these technical indicators. As you can see on the chart on your screen, 2016 was the upper echelon of this uptrend that instigated basically in 2014. We had this rampant uptrend that was basically too greedy for its own good. Got very toppy, right around 1,825,000. We explained, hey, time to get out of the market is now. And then there was a quote-unquote black swan, which was the foreign buyers tax announcement. And the market tanked, went down to 1.48, and rebounded to all-time highs in May of 2017 at 1.829. And what did our followers listen and hear us say then? Time to sell, right? This is a triple top in this market. We are going lower longer. This is a new economic reality here in Greater Vancouver where prices will dip back into previously established prices. What does that mean? That basically means a market cycle. Those that say market cycles don't exist are just completely incorrect. They do exist. What's different in the real estate market than in an equity market, they exist only to a certain period of time. So in real estate prices, prices always go up to another echelon and then retract into a previous level. Not a previous level from decades ago, but a near-term level. Unlike the stock market, which we're seeing right now, where it can enter and erase number of year highs. The real estate market isn't that. So we are long-term believers in the real estate market. However, the time to buy is not now. It wasn't last year, and it won't even be for the next upcoming months on an average basis for Greater Vancouver. We have said over the past few podcasts that there are a few subsects or areas in Greater Vancouver that are investable. We still hold very true to, or very firm to that. Those markets are only for owner occupied. They're definitely not for a strict investment purpose. So I'll actually just pull this chart back up because I think this is fairly important for everybody to pay attention to. So as we said, where we are right now in the February data was 1,600,000. Now that's actually lower, or sorry, higher than the 12-month average. The preceding 12 months average price would be $1,560,000. So right now we're basically $40,000 above that. We don't believe in this market where it is currently for a purchasing standpoint. We absolutely have believed in it to sell into this. Again, while other analysts said, it's time to buy. Whoop, now it's next month. Whoop, time to sell. The market bottoms in. Oh, now be scared because there's $400 billion lost in the stock market. It's time to be scared again. Well, it's very difficult for a person to buy a house and sell a house within a 2-month frame and make any money. It's literally impossible. So if you've listened to other analysts, you have paid the price, unfortunately. Now, Eitel Insights didn't, of course, not forecast a coronavirus and a global recession in stock markets. That being said, Eitel Insights clients that have ordered stock market forecast from us did know we were not believers in the market at 26.5, and we were definitely not believers in it at 29,000. It was way too far away from the technical indicators, but that is a conversation for another day. If you are interested in that, please reach out to Eitel Insights. With this real estate market, you're very much in this divergent trend that we've been talking about. And after a divergent trend, you see volatility. And of course, we're expecting the volatility to show up on the low side and prices to go down. What's interesting about this market reality, okay? The recession of 2008 was very much a financial recession, okay? The banks were in trouble and issues like that. It never really hit local proprietors, local businesses to the same degree that this economic recession is going to hit them. This recession is not a financial one. The banks are actually fine. It's the local proprietors that own businesses that are in trouble, basically on their own accord, right? The economic reality is changing. People aren't out as shopping as often. The housing starts are way down. Construction's way down. The money isn't flowing like it used to. And that was previous to this coronavirus issue. This coronavirus issue is a whole new cat that we haven't seen come to play. They've adjusted the interest rate, which is interesting to me, okay? If you do have the coronavirus, please, gosh, stay inside, take care of yourself. I don't think a 1% interest rate drop makes you feel any better. I don't believe it makes your family or your loved ones go out and want to buy a house or buy a car for that matter. One thing that we will say to take advantage of this changing economic landscape is to take advantage of a refi right now. If you're in a place where you're not fear driven, take advantage of it. The kind of rule of thumb is when you see a 75 basis points change from what you're paying on an interest rate, it's worthy of doing a refi. We saw a 1% drop in the last week. So if you haven't had a refinance for 5 years, I'd definitely be getting in touch with somebody because it's going to be better than what the ultimate reality is, especially with prices going lower. Now, why would prices go lower? Yes, it's true that people won't be going out and visiting as many open houses just for the fear's sake, but it's a lot more than that, folks. The reality will be businesses will be shut down out of this economic reality. We've been saying for a while, people have already been holding back. They get rid of their Mercedes, they've getting rid of their BMWs, they're leasing Volkswagens and Acuras, and just everything's been taking a step lower. That was previous to these new realities. Like we said, $400 billion has been wiped out of the Toronto Stock Exchange in the last week or so. That's real money, guys. A 1% interest rate, in my mind, does not change anybody's mentality to jump into this market to invest in real estate. What I believe it was more for, this is a banking regulation that of course has a mortgage reality. Really why I think it's in is for those that have lost money in the stock markets. People with money can borrow money on the cheap and recoup some of the losses and find their way back into this market so it doesn't actually go lower. It has nothing to do with housing helping or helping out the housing market. It's a overreaction to a global pandemic, both on an economic and on this coronavirus issues. Now, of course, they're hand in hand. You can't talk about one without the other. So, but this will have a longer term lasting effect than the 2008-2009 recession, because this will hit you in your pocket more so than the financial institutions that were in trouble during 2008-2009. So where we are right now, again, 1.60, that's right in the middle of our threshold. of the market cycle. Where we are from the peak is down 13%. Now, to put it in real terms, that's $230,000. That's a lot of savings. If you took our advice and sold at the peak, you're happy. If you've taken our advice and haven't purchased yet, you will be happy because prices will continue to go lower. We are at the very least expecting a price decline down to 1.4 million, and that will transpire this year. We're anticipating it probably in the next quarter or so at the very longest outset, which will be a total correction of 23% from top to bottom. Now, that could be a time to enter. The worst case scenario, just before I get into the worst case scenario, as time goes forward, of course, we will give you updates if 1.4 looks like it is going to be the bottom. Or if there's maybe another Black Swan that will come to this market. Of course, we'll give you the indicators while the fundamentalists continue to scratch their heads. So as time goes forward, we'll give you more guidance. As it sits right now, if 1.4 does not hold, the next echelon is 1.275, which isn't enough difference between 1.40, and will ultimately go down to 1.225 in our opinion. So that would be a total correction of 31%. Now, as it sits right now, I don't want to get into too much information. I will be giving more and more updates, more and more podcasts as we go forward in time, just with this market continually evolving. I heard some people that said, the foreclosures aren't out yet. Well, they are. And first of all, it's only February. The data just came in for the first 2 months of the year. As we go forward, the foreclosures will continue to show up. Just pulled it up today on, you can Google search number of foreclosure in Greater Vancouver websites. There's actually 49 detached properties that are in foreclosure. Now, what's interesting about those to me is I'd say about 95% of them are brand new built homes. So these are folks that got in during 2016 and 17 at the exact wrong time. Bought a piece of land, knocked it down, built up a beautiful palace that nobody wants at the price that they're asking. So those properties are in foreclosure, and we will see the whole effect kind of trickle down as the market continues to decline here. So like we said, the current data really shows it at the middle threshold. Where we're going is much, much lower. Please don't be a buyer here on the overall market in Greater Vancouver. For individual reports, that's what we do offer for a nominal fee of $250. So far, we saved you $230,000. $250 is very inexpensive to get to this kind of knowledge that we offer, this actionable intelligence for your individual areas, right? And of course, we do this on a national basis. Just speaking on that, I will be doing updates for Toronto, Fort McMurray, and Halifax, which is something that we publicly released about 6-7 months ago, and we will be giving you updates on those markets as well in the not too distant future. So before we start wrapping up with this other data, and I'll get through that rather quickly here. What is interesting about this foreclosure market with the developers buying in 2016 and 17 and so on, and taking time to knock down the property, build up the new one, and then offer it for sale, and ultimately have nobody show up and offer the money for it. What's interesting is that is going to mirror what will actually transpire here in this pre-sale condo market. Basically, people were buying during 2016, 17. It took 2 years, 3 years for the development to actually get built, and you'll see an onslaught of listings. One building that I pointed out in the last condo release is basically 50% available out of pre-sold, 100% gone. Roughly 25% of the building is for sale right now after only 2-3 weeks of being completed, and the other 25% is up for rent, and those numbers are continuously growing. What's interesting about that is that's a property very close, very much on the water. Properties around North Burnaby, around the Brentwood Mall, downtown, those aren't waterfront properties with a view. Those are strictly investments. Those properties will be hitting the market. It can't help. So again, the charts don't lie, folks. It doesn't take in, emotional feeling or, inventory's bottomed out. So, hey, maybe we think this is a market bottom and it's time to buy. We've never explained that. We've offered opportunities to sell into those and maybe, unfortunately, take advantage of folks that listen to other analysts that said it's time to buy. I bet those people are kind of regretting it now. So again, please don't be buying on the overall basis. It is still very much time to sell. We are very much going lower longer. Just quickly here, I'll get into the other metrics of the market. I'll toss up the sales numbers on your chart here right now. The month of February finished off with 686 sales, which is right smack dab in that middle of the kind of current market threshold that we see this sales market environment or the sales market living in. The top of this market, we could see maybe 950 sales again during the spring, summertime. And of course, we'll wait for the data to actually show us up and prove us up with time going forward. We do believe that the market will continue to see some sales. There is 30 to 40% of the market that always does need to move. The sales that will take place are the listings that do pay attention to this market going lower longer. If you ask too much money, you will just simply stay on the market. If you ask reasonable prices, you can achieve a bid, right? And that's an opportunity. However, it's the window for that opportunity is rapidly shrinking to achieve a higher price. With the more inventory coming to the market, you will ultimately see lower prices going longer. Now we'll get into the inventory. And we'll just toss that up again here. And so basically we saw 4,107 listings in the month of February, basically nominally higher than the month previous. However, we would again expect that to continually rapidly increase as we go forward in time, especially with some of these new fears, especially with a lot of money being eroded from the equities market. Margin calls being put forward to you. You might have to be forced to sell some assets. What's your largest asset is your house. So this will have a real life effect. Again, just for current market situations, there's 49 detached foreclosures. Healthy majority of those are all brand new properties. As we go forward in the year, you will continue to see more foreclosures show up and of course in 2021 as well before this market ultimately does bottom. Now, just before we actually do leave you here, one thing I do want to point out, maybe a little bit of positivity just before we leave you, is the days on market. I'll just toss that up. And we did see a massive lowering in the days on market with 46. Why is that? Well, maybe it's a few people that actually took our advice, listed a property at a reasonable price, and achieved a sale in a shorter amount of time than it has been basically in the last 6-8 months. That opportunity, again, is rapidly dwindling. As you see more inventory, as you see more fears hit this market, the market reality is definitely, with all of these economic realities, the coronavirus realities, there's no positivity coming to this market, folks. It's all negative, right? So as we said, we haven't flip-flopped, not once. We've said there's opportunities to sell. There hasn't been any opportunities for anybody to buy on an average basis. Yes, few individual markets, maybe only for owner-occupied though, not strictly for investments. All the other analysts that have been waffling will continue to let them waffle in the wind. And if you're looking for solid, strong advice that doesn't steer you wrong, guys, stick with the charts because they don't lie. Again, if you like this podcast, please give us a thumbs up. Subscribe to the channel. If you do have any comments or questions, leave it down in the section there, and we'll do our best to answer them on the upcoming podcast. Thank you very much for listening, and I look forward to giving you the next podcast.